Olá pessoal, sejam bem-vindos aqui novamente ao Event Connection. Eu sou o Thomas Rock e hoje a gente está com um convidado mais do que especial, é o Jorge Rovira. Ele é co-founder da Unicorn Strategic Capital e agora eu vou mudar para o inglês para a gente conseguir conversar aqui com ele, tá bom? Hello George, it's a pleasure to have
Hi,
you here
Thomas.
at Event Connection.
Thank you. Thank you so much.
George, can you explain a little bit more about Unicorn Strategic Capital and you are a co-founder? How do you build this company?
So we're Unicorn Strategic Capital. We founded the company 2.5 years ago, and our mission is, or was, our vision and mission was to basically be the bridge between wealth managers like Avenue and the global private markets or alternative markets managers worldwide. And to do that, we celebrated a joint venture with probably one of the largest operational / fintech platforms called iCapital. So we are the business development arm of iCapital in Latin America.
George, do you think what's the importance of events like this, like Avenue Connection for the Brazilian investors?
Oof, these are vital. First of all, we're super thankful to Avenue and for inviting us to the event. It's amazing to see the crowd. How many people do you have here? Like
Around 700 or 800.
it's amazing and very nice stage. So thank you for having us here. I think these events are necessary for two reasons. Basically, one, you need to educate the audience. So Brazil, we're probably going to talk about this during the interview, but Brazil has a very strong home bias. And many, like most Latin American countries, one of the reasons why home bias is so high is because we have a huge gap of education on what's out there, right? What do we do in global markets? How can I access global markets? In the case of private markets, even more so. So these type of events close that gap, right? We're able to speak to FAs, we're able to speak to clients, and that obviously bridges information that's not generally available to most of the assistants. And second, is just a very nice place to meet people, generate more business relationships. I'm sure there's a lot of networking and business activity going on downstairs and in the chat room. So I applaud the event. Thank you for inviting us.
No, we are very thankful to have you here, George. And talking about the home bias, you told the home bias of the Brazilian investor is huge. And you said also that the Latin America home bias is huge. Why do you think we have such a enormous home bias?
It's our nature, Tomas. It's our nature, right? We tend to invest in what we know, what we feel comfortable with. Most of our investors and clients, they like to touch where they place their money. So they walk in the streets and they go to Itaú Bank. They see the queue of people trying to go in. So they feel that they should invest with Itaú, etc. And that's normal. That happens everywhere. However, we have to be aware that definitely there's concentrated risk in just putting your money in your local jurisdiction. That risk can come from political reasons, higher inflation, currency volatility, which you have lived yourselves in Brazil and we've seen in other countries in the region in the last 3 to 4 years. But more so, and the reason why I always try to get clients involved with global markets is that most of our countries are very involved in commodities, industry. You're missing a lot of the story of growth out there.
Yeah.
If you want to play technology, if you want to play healthcare, if you want to play energy transition themes, you need to look abroad and look for other growth opportunities. And that definitely solves, in my opinion, the most important problem that we're solving in the financial sector, which is preservation of wealth. How do I preserve the wealth against all the volatility that we can experience, right?
And we cannot talk about global markets without talking about diversification. So, in your view, is the diversification just starting here in Brazil and Latin America? And does it make sense to include like alternative investment, alternative solutions in a portfolio? What do you think?
Definitely. So the trend is varied in the region. I would say Brazil probably has the highest home bias in the region. Obviously, it's a very large market. You have a well-developed or relatively well-developed capital markets as well. You have a very large stock exchange. You have alternative investors, local alternative investors yourselves. Very high interest rates. So
Very high.
so there's definitely a higher home bias in Brazil versus other countries where dollarizing your savings is more probably natural. If you think about Mexico, Central America, even Colombia,
Chile, I think you can have
Chile is very
an account in
diversified.
dollar.
Definitely. So if you compare the region with Brazil, Brazil is probably less than 1% invested, between 1 and 2% invested abroad.
Yeah.
So very large home bias. Rest of the region is probably between 10 to 15% invested abroad. Still very low, to tell the truth, so very high home bias. When you diversify, again, you're looking for other growth opportunities that are not available in our countries. And two, you're basically lowering the risk that we are all exposed when it comes to political risk, inflation risk, and currency risk. The only way to diversify those risks is taking your money out, okay? Once you take your money out, the question is, where do I invest? Equities, bonds, alternatives. For your second question, I would say alternatives is a must. Recent market changes since COVID, I would say, have brought the correlation between bonds and equities very close to 1. So it's very difficult to diversify in a portfolio of bonds and stock.
The famous 60-40.
The famous 60-40, which is in every book that we read in the university, etc. You have to change that mindset because you're not really getting diversification by having those two ingredients. Alternatives provide that diversification. So correlation between alternatives and public markets is still negative. And total return on most of the private market side of things is 300 to 500%, 500 bips, higher than their public equivalents in the last 15, 10, 20, 25 years, regardless of the time window. So it makes sense for an investor that can think long-term to have a either 2% or 20% allocation into alternatives would make a lot of sense in order to really diversify away risks.
And the percentage depends on the risk tolerance of the investor. So if you have a conservative one, probably the percentage is going to be lower. If you have an aggressive investor, it's going to be higher. Do you have a kind of number, or really depends on each investor?
It's a super important question. And I would say the most important risk when it comes to alternative investments, the most important risk is liquidity risk. So the question that I always ask my clients, and it should be the first question before you actually start building a portfolio, is how much of your money you can live without in the next 3 to 5 years. When I say you can live without, is that you don't have the need to pay any obligations. You don't have a need to make a purchase of something that you're looking for, or you don't have to pay for your son's college in the next 3 to 5 years. If you identify the portion of your portfolio that can be truly liquid for 3 to 5 years, alternatives is the only answer for that part of your portfolio. And the answer to that question can vary. In Latin America right now, the average allocation to alternatives is 2%. Only 2%. When you go to Europe and you look at the wealth segment, it's 10%. When you go to a pension fund in Latin America, except for Brazil and other countries who are not yet investing abroad, but for the pension funds in Chile, Colombia, Peru, the allocation to alternatives is 20% because they invest long term, right?
Yeah.
So I would say the risk tolerance part is a key question, but it's a risk tolerance towards liquidity. How much of my wealth I can live without in the next 3 to 5 years? Whatever that number is, that's the alternatives allocation. The rest you can invest in bonds and equity, which you need to liquidate immediately, right?
Yeah.
That's the catch, my friend.
No, makes total sense, Jorge. And I wanted to talk about something that we saw in this first semester. We saw a lot of volatility in the markets, and some things that we never thought would happen are happening right now. So what are your thoughts on alternative investments on the second semester of 2025? Do you think we are going to see even more volatility, or the things are going to cool down? We're going to see some more normal things happening?
Knock on wood, Thomas. So I think volatility is a part of the new market regime. So we need to start living with volatility. We've spent 15 years with zero interest rates, right? So the last 15 years was 0% interest rates. Now we're at 4.75 interest rates and probably going down to 3.5. That's what the markets are saying. And I'm talking about the dollar Fed interest rate, which we all build upon, right? Everything is built upon that rate. 3.5%, Thomas, is a completely different regime than zero. Okay? And that is definitely bringing a lot of volatility to the markets. And you see it in all aspects, right? Volatility in prices, volatility in Fed and monetary policy, not only in the US, but in the region as well. And obviously you have also geopolitical risk. That, I think, is the new market regime. We should start living with this volatility. And for that reason, diversification becomes even more important. And diversifying into alternatives becomes even more important because private markets, because the way they're built, which is being an activist investor, you buy companies and you operate those companies. So you need time to build revenue growth, margin expansion, build new technology, do research and development. Running a business like Avenue, for example, it's an operational endeavor, right? It's a day-by-day endeavor. You cannot think about Avenue as a 2-year or 3-year project.
No,
It's a
more than the case.
25, 30-year project, right?
Yeah.
So that is the reason why an alternative or private market investment is less volatile than the public market, which captures all the information on the daily price. It's tradable, executable every day.
Every news
Moves the market. So that's why you need this ingredient into your portfolio to normalize it. If you talk to a private market investor and you ask about geopolitical risk or tariffs or the interest rate environment, it is relevant. You take the risk into account. But most of these guys see it as an opportunity even. Okay, what's the next big thing? For example, giving you an example, if you have tariffs now,
Okay.
tariffs affect importers, right? So you probably need to look for groups that benefit from higher costs to importers, which are the local producers. So local producers benefit from higher tariffs because they get less competition, right? So many of these private investors are looking to invest in local companies in the US, companies servicing local markets, okay? And that vision, the ability to think long-term, allows you to navigate better these volatility times, which in my opinion are here to stay. We need to grow accustomed to it.
No, they makes total sense, and I think the zero rate of environment that we live in the last, I don't know, 20 to 15 years, it spoil us. I like this world because we got used to something that is not very common. When we see, I don't know, the interest rates in Japan being negative, we don't study this kind of things.
Doesn't make any sense. Doesn't make any sense.
When you say that you're going to lend money to someone like $100 and they're going to give you back 99 and you are happy about it, it's
And in
that-
30 years, and in
Yeah.
30 years time, we're so.
it's totally crazy. Jorge, going towards the end here, you talked about the liquidity risk of an alternative investment. Apart from this liquidity risk, what risks do you think the investor, especially here in Brazil, needs to be aware?
There's like in everything has risks, right? Liquidity is the most important in your conversations with clients because it's the most difficult to grasp.
Okay.
But then when it comes to investing in private markets has the risk of its own, right? So first and foremost, in my opinion, it's who is operating the investment. If it's a private equity manager, the management risk behind the company you buy and you operate is critical. The dispersion of returns between the best managers and the worst managers can be of 30-35% per annum, right? Not like in the public markets, if you invest with the best or with the worst, the difference is 2.5% per annum, right? So you're not risking that much. But when you invest in private markets, manager selection is key. So having access to the global with the most expertise private markets manager is super important. Obviously, you get the market risk in a private market investment, interest rates, currency risk. However, given the fact that these guys are investing in the long term, it provides the opportunity to hedge those risks, to diversify the business model, to think about where the company should be growing next, if I should acquire and grow inorganically, or should I invest in talent to grow organically. I think there's more chances to maneuver when you have a private investment. However, you're exposed to all market risk. Cost of capital is key. Exchange risk is key. Macro risk and geopolitical risk are very important also in the private markets. But given you have a longer time horizon, I think it's easier to navigate.
When we talk about this, we see the importance of having an advisor to help you talk about the liquidity. Because when you say liquidity, is like, I want my money today. No, you're going to wait like 3 months, 1 year, 3 years.
Exactly.
So you need someone to help you understand this private market. But if you have the opportunity to wait, and you don't need that money right away, as you say, it makes sense to put some part of your portfolio in an alternative market.
100%, Tomas. And there's also options between the alternatives, right? You can invest in private equity, which is a long-term growth of capital type of risk, but you can also invest in private credit, and you get a coupon, you get coupons, you get distributions. So there's a way of playing the game as well in private markets to accommodate your risk profile. You could even build a 60-40 solution on the private market side, right? That's what we're seeing in the region. Actually, in the region, most of the Latin American investors are starting to fall into a type of 60-40 portfolio in private markets, where they have 60% private credit and income-related strategies and 40% private equity or growth strategies.
Sure, I'm pretty sure we're going to see this market grow like in a lot of percent in the next years, for sure.
Thanks to Avenue, I'm sure it will.
For sure.
Thanks to partners like Avenue.
Jorge, thank you so much for the interview today. It's a pleasure to have you here at Avenue Connection. Trocando de volta para o português, pessoal, muito obrigado pela entrevista, ter passado aqui o tempo conosco. Se inscreva no canal para acompanhar todas as nossas notificações, os nossos vídeos aqui dentro do Avenue Connection, tá bom? Muito obrigado.
Obrigado.